Well, good morning or good day, everyone, and thank you for joining us for today's Interactive Brokers webinar. This is Cynthia Tomaine with IB, and I'm happy to present or to bring you today's event on learning powerful new ways using those gaps and event-style bars when trading future products. And we do have with us today a representative from the CME Group, Dave Schultz, and Dave is going to give us a brief product overview before we actually get into the presentation. So Dave, if you would unmute your phone, I'm going to pass you the ball, and if you could give us a brief overview of these products. There you go, Dave. Thank you for joining us.
Thank you, Cynthia. Good morning, everyone. Hi, my name is David Schultz. I'm a director in our FX products at the CME Group. We're very excited to have Tim Morge give a little overview on our products. Certainly, to give you an idea, we access the world market opportunity. We not only have our foreign exchange products, but we have stock indexes, agricultural commodities, energy, metals, and interest rates. One of the things that when you trade the CME Group markets, you have equivalent market exposure with lower capital requirements. You have no uptick rule or short selling restrictions. You have around-the-clock markets, and you have the financial safeguards of a regulated exchange. And one thing to note on the financial safeguards, the CME foreign exchange market is the largest regulated market in the world. Just to give you an overview of our FX market, one thing to note is, we are the second largest foreign exchange market where you can trade daily. And that's really important to note because there are a couple others that are in the interbank or the actual large-scale bank trading market where they access a few of our competitors. We are number 2. We trade over $120 billion in daily liquidity. We have 56 futures and 31 options based on 20 currencies. One thing to note, if you're an experienced trader, certainly you can look at all of our currencies that are mentioned in the 56, but you're probably going to keep your eye on the euro. And in our euro currency, we trade approximately over 50 billion a day in a notional value. In our Japanese yen, we trade over 10 billion. In British pound, we trade over 10 billion a day. The Canadian dollar, the Swiss franc, and one of them that has really grown, again, as well as with the Canadian dollar, is the Aussie dollar, these commodity currencies. The Australian dollar, we've seen just significant growth, and that currently trades around 10 to 15 billion a day. When we talk about a level playing field, I think this is one of the most important things that you should note when you're trading. You have the same opportunity to trade as a bank or anyone else, a hedge fund, in our currencies. And why is that important? We have a FIFO system. We have a first in, first out. So if you're a 1-lot trader or a 500-lot trader, you have the same access to that price. And one of the things to note as well when you trade our products, if you see the bid and the ask, you actually can join the bid, you can join the offer. If you'd like to improve the bid, you can do that, or you can improve the offer. Again, we have a 23-hour market. Our market opens up at 5 p.m. Sunday evening, Central Standard Time, and we trade to 4 p.m. for the next day. The safety and security, of course, you have the unparalleled backing of the CME clearing, which virtually mitigates counterparty risk. So in other words, the CME clearinghouse is the buyer to every seller and the seller to every buyer. The main point, which is really great when you trade our products, is the access to a diverse base of global market participants, which are banks, hedge funds, proprietary trading firms, and active individual traders. So you're not trading with one individual dealer. You are actually trading a variety of all the global participants, and this makes it where our markets actually have so much liquidity in these markets, and it gives you equal access to all participants to trade. If you look over to the right in our CME equivalents, this is a very, very important tool, and I think you'll enjoy just to get an idea of how the pricing works. You can see the our link to that website, cmegroup.com/equivalents. What I'd like to do is just really briefly talk about it. It's very small on your screen, and I think once you view it, when you take a chance to view it on your computer, But what it does is it actually takes our futures prices, and if you are currently trading any type of spot market or any foreign exchange cash platform, it takes our prices and actually converts it into spot equivalent. The most important thing is I would like you to do if you are currently trading those is compare those prices to ours. I think you'll find that our liquidity, our volume, and our bid-ask spread is very, very competitive. So if you have a chance, take a look at it. If you see on the left, actually, can they see? Let's see if we can blow this up a little bit. Okay, perfect. So if you look where my little red dot is, actually that will give you our depth of book. That'll be 5 deep on the bid side. And if you look to the right when you have a chance, we're just going to go over this quickly. You have our depth of book 5 deep as well. That's very important so you can actually see all the different prices in that 5 deep. The first one, you're going to see 3 different fields, 1, 2, 3. The top one that you will view first will be our euro currency. That is, of course, our most liquid. There is a drop-down arrow. You can view all our different currencies and see the bid-ask spread and the amount of trading going through. This will be your bid and the price, and this will be your offer, the amount of contracts, and the price as well. Again, when you view the CME equivalents, if on top there is a toolbar, and it says if you need to contact us, you can actually drop down on that link and access any one of the CME FX team, and we'll gladly run this through you. But I think once you take a look at this, you'll find that it is very, very helpful and useful in terms of the pricing. And one quick note I would like to mention as well that is not on the screen. We do offer E-micros. We have 9 E-micros that are 1/10 the size. So if you were to trade our standard size, this larger euro currency, the average tick value or point value would be $12.50. If you traded our our E-micro, you would be trading, it would be right around $1.25 per tick. So it's a great way to start and to get used to trading our products as well. On that note, I'm going to end this. I'd like to turn it over to Tim Morge. I've known Tim certainly a long, long time. Tim is one of the larger bank traders. I've been around for about 30 years myself and traded on the floor. And when Tim was trading, he was probably one of the largest traders that actually accessed our markets. So I think his knowledge and his experience in the market is going to be a tremendous way to learn his insights and what his trading is. I want to thank you for your time today, and I'm going to turn this over to Tim. Thanks very much.
Hi, Dave. I hope everybody can hear me. Cynthia, it's always a pleasure to do anything with you. IB Education is the best there is. Dave, I haven't talked to you in a few months, but Dave and I go further back than either one of us want to admit. Before Dave was married, I think actually before I was married. And wonderful guy, knows his stuff. If you ever need anything at the CME, and you're lucky enough to get Dave, you'll get the full skinny, as they say in Chicago. IB has mobile apps. Oh, okay, there you go. Pay attention. They're always on the cutting edge. Let me just tell you this. The CME does as well. Okay. So go in the App Store and take a look. It's hard to keep it. Stuff comes out so fast, it's hard to keep in touch with it. But I'll tell you, I use CME equivalents all the time. You can use it to compare charts. You can use it to compare prices and go back and forth. The cash market to decide which is the best for you. It really does. It's a great thing. We're going to try and up the volume, it looks like. I'm as good as I can do on this end, Cynthia. I'll talk loud if possible. I'm fine? Okay. So today, well, let me go through the basics. How about that? Let me change one thing real quick. Okay, now I've got my pointer on. I'm president and founder of Market Geometry, and one of the things we try and do there is teach traders to be more consistent in their trading. And a good part of that is learning how to read price. We call it the language of price. And it's nothing more than that, but that in itself is very powerful. Let's talk about, I'm going to do a brief disclaimer. Anytime you gather to talk about financials, anywhere in this world, you have to do a financial disclosure. You can read this. It's very similar to what Cynthia put up, but everybody has their own. I could change it on a regular basis, but let's boil it down to one thing. There's no Holy Grail. If you came here to get the Holy Grail, I don't have it. Hope you stick around anyway and see that the information is interesting. But the closest I can think of to a Holy Grail is hard work. And it's not the magic, sexy setup that somebody sells you for $195 a month. It's not a chat room where some guy calls out prices for you to get in and get out. It's none of those things. It's learning how to read price and understanding, what leads to what. It's like anything else in this world. It's learning your vocation. It's doing the hard work, and then it's coming to the market. Because remember, on any day, and Dave's exactly right, on any day, you're likely to run, if you're in the marketplace, and think of the CME group, first in, first out, everybody's equal. You're likely to be up against, your bid may be out there against the best hedge fund trader in the world. It might be out there against me. It may be out there against a couple of the guys on the board at the CME that I know that trade huge amounts of currencies. It might be against another small trader if you're a small trader. It doesn't matter. Bring yourself prepared. If you're not prepared, don't come and trade, because those people are going to pick your pocket. You don't want to be guppies for the whales. That's one of our sayings. The whales are large traders. Instead, that doesn't mean you can't trade along with the whales. Just be prepared. That's the Holy Grail. Okay? Brief note. This year I'm going to dedicate all of my webcasts to my two early mentors. Both passed away. Well, my first was Dr. Alan Andrews, and he was a great market researcher at MIT. And he was a Newtonian physicist. And he applied Newtonian physics in the 1920s to develop the median line. And it's one of the only, it's the only one I can think of, but I'll say one of the only true leading indicators available to traders. And then my second mentor, who passed away, I wasn't in the market very long, but I had a nice long period with him at Princeton, Amos Hofstadter, and he, I believe, was the best campaign trader in the last 300 years, which is a pretty bold statement. But he was really the master of risk, reward, and money management. And the guy that taught me, people say that I have surgeon-like money management and risk control and risk reward and portfolio management. And I give all my props. It all came from Amos. So there are very few of us around. In Dr. Andrews' original group, there's only 8 of us left alive. And there are less alive in Amos's that were around Amos because he died in the late 70s. So I'm going to highlight both of their works this year and give them their props. I want their work to live on forever. So today we're going to talk about using gaps and event-style bars when trading CME currency futures. Okay? So let me show you how we teach topic-based materials at Market Geometry. Now these slides were done by my partner Shane Blankenship. The words I'm going to say are my own, so I'm not going to take those out of his mouth. But the slides are so good, I decided not to change them. But I just want to give you a peek at some of the things we do for members, and it's 5 or 6 slides, and they're extremely enlightening. And these lectures are on the nature of individual bars. This particular lecture, and it goes on for about 45 minutes. We're not going to go on that long with it, but the lecture focused on how an individual bar can determine market structure and signal a change in the flow of the market. Understanding market structure is an important key to becoming a consistent trader. Now, it's no coincidence that Mickey, the Sorcerer's Apprentice, is on this chart. I pride myself on being a Newtonian physicist, and the best and most famous alchemist or sorcerer was actually Sir Isaac Newton. Maybe you didn't know that. Now, if we're lucky, we'll be able to turn what we see on a chart into gold. Price charts are made up of price bars that represent the human behavior of buying and selling. There's nothing mysterious going on here. It's simply the laws of supply and demand playing out in front of us. There's an order to price action if we just slow down, roll up our sleeves, and look at the charts bar by bar. And you can see, to start this out, we've got nice orderly action, we've got a pullback, and then we have an event bar. We don't know what this means, but if you're sitting watching your chart and all of a sudden this bar unfolds in front of you, you should sit up straight and pay attention. It's telling you something. Here's our first look at a wide range bar. Actually, the prior slide showed one as well. There have been many setups and strategies built off this type of bar that usually represent an event. If charts are a story that we're reading, a wide range bar is one word or maybe one small sentence in the language of price. This bar represents a shift in volatility, really a shift in supply or demand. Something is signaling a change. Something interesting is going on. Now we can use this as a marker. I don't know how we'll use it, but we'll eventually use this as a marker. These are extremes where traders are stepping up and showing their hand, and it's generally the larger traders, the whales. We should know where these areas are so we can use them when reading price and making trading decisions. We don't need to act immediately, but we do want to read the outcome of this volatility and take advantage of that edge. Now, where they happen in the trend is very important. That's called context. These markers can be a sign of trend exhaustion or trend beginning depending on where they show up. In this presentation, I'm going to show you how to recognize them and some of the ways I use them, as well as another marker that shows there's been a change in supply or demand, which is the gap. There are many other ways to use these markers, but let's start out by just learning to recognize them. Once you recognize them, you can begin to look for ways for you to learn to use them in your own trading. Sorry, I was reading the comments. For most of you, the sound is good, so you should be all good. Now here's a blank chart. Slow down, take a moment. Do you see any wide range bars that stand out? What else do you see? Take a minute and give this chart a good long look. I haven't drawn anything. I just want you to look at it and see if you can identify for yourself some events on this chart. Everybody sees the gaps. There's some other things on there as well. Okay. Somebody got the right answer and then lost sound. See, that's what happens if you get... Anyway. Excuse me. Let's take a look and see what I see. I see an outside bar that breaks above market structure right here. This outside bar produces an up move, and then the low of the same outside bar right here offers support in this energy coil or trading range. See price come back and test it. There's our first wide range bar. Sometimes we call these bookends. Offer support. Now we take off. I also see two large down bars that close near their lows. Look at this wide range bar. Closes near its low. Look at this bar. Closes near its lows. Actually three. Look at this one. Closes near its low. I marked these with blue arrows. But look what happened after those two large range bars lower. In both cases, price moved up significantly. In this case, we made new highs. That tells me something about the follow-through of these sellers, and it tells me something about the likely overall trend. What else can you see? I marked two of them with green arrows. I also see price gap higher twice, here and here. And price continues higher after both of these gaps. This tells me something about the quality of the buyers, and it also tells me more It adds to the picture of the likely overall trend. I'm not trading yet. We're just reading price. I'm using the language of price to put together a market map. Now let me add a median line set. This comes directly from Dr. Andrews' action-reaction course rules. You can get them free over at marketgeometry.com if you want to read them. They're 61 pages. He sold them from 1965 until he passed away in 1987. These are 3 key rules off of his action-reaction course. 1, prices will reach the latest median line or its parallel 80% of the time. And you can see here, A, B, C, we're coming off the lower parallel, and again, price reached the median line, and it'll do that 80% of the time. 2, prices will either reverse on meeting the median line or gap through it. In this case, price gapped through the median line. It accelerated. 3, when prices pass through the median line, they will generally pull back to retest it. You can see price gaps through, or zooms through, pulls back and retests the median line. Now, Dr. Andrews considered gaps as pivots that you could measure. Remember, when Dr. Andrews was trading, markets were not trading around the clock. Markets traded what they called the gentlemanly day of 9 a.m. to 3 p.m. You have plenty of time to have your coffee, get to the office, read the news, then decide what to do. You got plenty of time after the market, get in the car, get home. There's an evening newspaper at your house, read your evening newspaper, have dinner with your family, and relax. The markets didn't trade overnight. You didn't have to worry about it. One more time. Then news or events that came out that would get resolved in the morning when the markets reopened. So people would have their coffee and then say, well, look at that news from American Aluminum. I think we're going to have to open that higher to fill these orders. They take a look at their books. The specialists or market makers would look at their order books and decide where they could open the market and have the buy orders meet the sell orders. The market would open where traders, specialists, or market makers were willing to agree to facilitate trade. These imbalances created a gap on the opening after news or an event. Now think about this for a moment. Often, quick decisions have to be made on unexpected news, and the first round of sellers ask an exorbitantly dear price because of the uncertainty or the volatility. In other words, okay, the market just opened. If you want out, here's what it's going to cost you. And if you want out, there's no choice but to trade with a specialist. And whatever price he's charging, that's it. That's where you're going to get filled. Now let's understand why many gaps get filled. I happen to live in the Arizona mountains where Doc Holliday and Wyatt Earp were the peace officers back in the day, as they say. What did they say when unexpected events happened back then in the streets? Shoot first, ask questions later. Actually, there's people here that still say that. Now, in the markets, over time, after everything has calmed down, the participants can assimilate the event and decide on what price the news is actually worth. So once the news has been mulled over and the people that needed to get out and had the knee-jerk reactions got out, things calmed down, cooler heads prevail, the price may not be quite as dear. Alan Andrews considered gaps to be pivots. He considered them as swing high and swing low pivots. So each gap could be a swing high or swing low. These pivots can act as support or resistance, or they can be used to draw a median line. Now, if you think about it, this makes sense that we can measure from these points because they're often extremes, at least locally extremes. Now, I don't want to make this into just a gap presentation. So I'm going to propose that wide range bars can often be looked at in the same way as we look at gaps. They carry many of the same attributes. And we'll see as we go forward how that plays. I used a little of Mickey's alchemy on the prior chart. This is the same chart. It's a chart from a 24-hour currency market. Now notice the first gap on the chart here is a true weekend gap. The second gap, Mickey magically turned, magically and deliciously, as they'd like to say, turned it into a wide range bar. This is what actually happened. And yes, somebody caught me. We just erased it out and left it as an open gap. And that's what we would have seen in the old days when there were 24-hour markets. Price would open up here. But in this case, actually open right here. In this case, price zoomed or ran through. We call this a zoom. Wide range bars function very much like a gap, and here's a perfect example of it. I'll go back for you. Take a look at the chart. Here it is if it had been an overnight gap. And here it is in the 24-hour markets. It's just a zoom through the median line. Still an acceleration or a zoom, still traded the same way. These are key events that represent a shift in volatility. I treat gaps as possessing swing pivots, swing highs, swing lows, and I view wide range bars as very nearly the same way I view gaps. They possess similar qualities. Here's some homework. I don't believe I show this today, or we'd be here for 3 or 4 hours instead of the 1 or 2 that we're going to be here. But if you pay attention, wide range bars, you can use their extremes. But if you do your homework, often as swing highs and swing lows as well. I'll leave that for you as homework. Now don't get lost here. I'm just defining gaps and wide range bars before I begin to read a market and show you how these event bars play out as I read a chart. Let's all take a deep breath, get settled, and start to read some currency futures charts. Before I start, let me get the next. Before I start on this, Dave gave us a. Oh, Dave left. Okay. Well, Dave, I'll give you good props anyway. Dave gave us a great tip again. CME equivalent. If you don't know about it, when you get the slides, take a look at it. It's a great tool that allows you to compare cash FX prices and charts to CME currency futures. So you can. Let's say you like to chart the cash FX better. You can take a look at the cash FX, say, oh, here's the cash FX price, then convert it into CME currency futures price. It'll do it right there for you automatically. And you know right where you are on the CME currency futures chart. And you can, on your IB platform, if you're trading currency futures, you know just where to put in your bid or take the offer. So let's look at the CME. Dave said the euro was the one. I didn't know Dave was going to be here. I think Barbara's busy or taking the day off. That's okay with me. I love Dave. Dave's wife worked for me for 4 or 5 years and was a wonderful, wonderful trader, wonderful young lady. Since he mentioned CME euro currency futures, luckily, let's look at the CME euro currency futures. We'll see if we can find gaps and wide range bars and observe how they determine market structure, support, and resistance. Hopefully, we'll find something interesting enough that we might be looking at a trade. So here we go. Again, this is 6E on most of your charting programs. This is the Euro FX currency futures from the CME group. It's the largest currency future there is by a factor of, I don't know, 3 or 4 or 5 to 1. Certainly the most liquid. If you pay attention, the bid ask is nil. This is a good question. I'm not going to answer many questions, but it is a good question because I don't have it up here. I should have up here a title, CME currency futures or Euro FX, and also say 20 minutes. This happens to be a 20-minute, I believe. Remember, I prepared this right after the holidays. I was probably still recovering from the... I was in Vegas for a week with my wife and family and my partner Shane, so hopefully this is cogent, as they say. So here we are. We're looking at the Euro currencies. Before I draw anything, let's take some time and just take a look. Anything interesting on this chart, or is it just ho-hum mundane? This is what's going to make the difference between you being somebody that can read the language of price, somebody that can understand where the buyers and sellers are, somebody that understands where the whales are. Whales are people that trade large amounts of money. I trade huge amounts of money for sovereign funds. And if you don't know where the buy and sell orders are sitting from money managers like that, you're giving up a huge edge. It doesn't mean you can't make money trading, but you can lean on your friends if you know where the whales are at. So everybody take a look, then I'll go forward and draw some stuff in. All right. The first and most important thing I see is we have, right at the end of the year, this beautiful gap. And the gap is followed by very low volatility. Price, that means price is restoring its energy. It's like sitting at the gas pump and filling up your gas tank, including that extra little reserve. This gas tank is full to bursting, ready for something to happen. And indeed, something happens. What do we get? We get quite a sell-off. Let's dissect what happens. Same chart. Let me go back and show you. No magic. Same chart. This is me in the morning. This is how I actually mark up my charts in the morning. Okay? What do we have? We've got a gap zone here. We have low volatility. So price is restoring its energy. Then, price spends its potential energy. And look at the wide range bars. Price makes a wider range bar, closes on its low. Makes a wider range bar, closes in its lower third, blows through the bottom of the gap zone. Makes another wide range bar lower, closes near its low. Makes another wide range bar, close. Look at them. 1, 2, 3, 4. They're just stacking them up. They can't get in front of each other fast enough. They slow down for a bar, go right back after it again. Look at it. Another wide range bar, closes on its low. The day finishes. We actually get a gap. Remember, futures are closed briefly. We actually get a gap. They rally price up, and you can see there's sellers here. It's not going to get above this area. All these people that had to dump, there are people that had to be buyers on the other side. Every trade has a buyer or a seller. All this got dumped into the market. As the market starts to rally, it comes to this last bit of consolidation. And what's it do? Runs right into whales. Runs right into large sell orders. One way we can identify this, I can tell you, being a whale, and I'm not talking about my weight, when you see this, you can see price came down, left a low, rallied out of the hole, found sellers, came down, left double bottoms basically. They don't have to be to the tick. That's close enough for jazz. especially on nearly the last day of the year. Then as they tried to rally it, look at these bars. Lower high, lower high, lower high, lower high, lower high, lower high, lower high. That's called a press. Somebody has something to do. What do they have? They want to sell as much as they can. Let me change tools here. Before we break those bottoms. How much can I sell? Because I don't want, if I'm out in this market, I don't want to be chasing price down here, because if I'm selling down here, I may be chasing this market all the way down. So the press shows there's somebody that's got what we call wholesale to move, a large amount to move, but they're not going to change price. The moment we break out below these lows, they're done, because they know if they keep going at it, price may collapse on them. So they step back. Now, no offense to all the retail traders out there, what do we get? We get people that are breakout sellers, breakout. If it makes a new low, I have to get short. We have people that are getting stopped. They tried to pick a bottom because it was a double bottom, so they left orders to get long here. They get long. Now their stops are getting executed. You had people that were accumulating in this area and they just can't stand the heat anymore. And so there's a final sell-off. And we make a gap low, or actually not a gap low, a spike low. Come up a little bit. Another wide range bar, but look, it closes nicely up. So you can see price working its way up. So now we've got a swing low here. Now, here's our prior high. Here's our major swing low. Pay attention. This is very important, very simple, but very important. When price leaves a high, leaves a low, then takes out this high right here, that makes this a swing low. Now we've got a swing low. When this high leaves a low and the high gets taken out, that makes this a swing low. So it's a back and forth motion that confirms swing highs and swing lows. And they're important because they will enable you to follow the action. Are we making higher highs and higher lows, or lower highs and lower lows? I don't use any stringent rules, like Ellioticians and some other people, after 4 bars, X, Y, Z. It's not the point. You have to have a swing low before you can have a swing high. You have to break a swing high to confirm a swing low, et cetera, et cetera. We're fortunate enough that IB, Interactive Brokers, and the CME group has allowed the second Thursday of each month to be market geometry presentation day at noon. So this next month or the month after, we're going to do a whole thing on swings because they're so important. I'm just identifying swings. But let's go ahead and go. So we're making higher highs and higher lows. Is this a change in behavior, a change in trend? Take a look at the chart, think about it before I move on. Again, I know you're typing questions. We'll answer questions afterwards. If I try and pay attention to questions, I'll lose my train of thought. The presentation will go much better if I present what I'm trying to present, and then afterwards I'll be more than glad to stay until the very last question is answered. So, have we changed trends? Think about it. Okay. There are different answers. Let's see what we get. Okay, so we've got higher highs and higher lows. Now take a look. What do we get? We get a major gap higher. Look at it. That's a big gap. First thing to ask yourself, remember I said earlier in the presentation, you get this gap. So many people have got to trade at the moment. Now, certainly, if you have a position, always have a stop in the market. If this market gap's open and you're short, you should be stopped out and be happy to be stopped out. Why? That's what stops are for, okay? They protect your capital. You don't want to get up here and then watch it and try and decide whether or not to get out. Just have your stop in the market. If you get slapped, you get slapped, but it's a minor slap, okay? If you let it run, it can be a slap that you may never recover from. But other than that, if you don't have a position, do you really want to chase price after this type of move up? Do you want to pay the market makers, the whales, if you will, whatever the price is they mark it up to on the opening? You better have a damn good reason. Price often settles down. Now, I'm not saying it's going to come all the way down, but, pay attention, mark your chart up, think about it. What do you have? Where are the significant buyers and sellers? What do you have right in front of you? Price gapped higher, sure, it looks wonderful. And maybe you got long down in here. Let's say you had a small median line from this low, this high, and this low, and it cut right through here, and it got you long on a retest here or a retest here. So you're in relatively close to the bone with a good stop. Now you've got money in it, and you can collapse your risk. That's different. But after price has now come out of the hole so far, and you're so close to what could be, we don't know it is. We don't know if there'll be any sellers there, by the way, but there may be. And if they are, is this the time to be jumping in on the opening? I think you want to buy a buyer or two and see what you get. But that, again, that's just me. So let's see what we get. Price tests the gap zone. Trades higher. Closes below it. Gap's still open. Again, we're making higher highs and higher lows. Is this a change in trend? Well, what should you be asking yourself? Are these sellers still there? The question is, where are the significant buyers and sellers? In this case, the question has to be, if there are sellers, where would they be, and are they there? So again, one bar tested the gap zone and closed below it. Ask yourself this, has anything changed yet? We still have the gap zone. We have two things. We have an open gap below, and we've got the gap zone as resistance sitting right in front of us, and we still don't know about these sellers. Let's do a little exercise to see if we can make it easy. I came up with this, I don't know, 9 or 10 months ago. I was doing a presentation at Market Geometry, and it was in the Aussie, actually, and Dave was talking about how active the Aussie's been. We had one of those weekend gaps where price just absolutely ripped open the Aussie. Just a huge gap. It was, this is a big gap, much bigger. Just astounding. And it was almost as if you took your hands and put one hand on one side of the paper over here and one over here and just ripped the chart in half and disconnected price action on this side from price action on this side. That's where we got the name now. We call this a gap rip. But here's where it is really. Okay? Price is ripped away from the continuous flow of the normal price action, because here you can see we've got sustainable, especially here, sustainable highs and lows and highs and lows. There's nothing magic going on here. It's a little bit of a wild ride here, but it's continuous. What do we get here? A huge gap. Now we've got some continuous action, but it's not connected at all to this action at the moment. So if sellers are not still here, what are we likely to see? Price has been ripped away. We're likely to see price find support. As it comes down into this area, we would call this a multi-pivot line. You just connect all these bottoms, excuse me. It's right at the bottom of the gap zone. We'll probably see support as we come down here. Not a bad place for an entry with a potential stop down here. And then off to the moon, Alice. It's if the sellers are not here, this swing's job, Price's job, is to make new swing highs. And by new swing highs, I mean take all this action out to the left. Just completely blow this part of the chart away and make it meaningless. That's if the sellers are still not here. If the sellers are there, we'll likely fiddle around in this gap zone area a little bit where we try and figure out whether or not they're there. Then either people will figure out that the whales are sitting up here, or one or two of the whales will break away from the group and start to sell a little bit cheaper to get ahead of their buddies. My general advice is, at any one time zone in these major markets, there's 3, 4, 5 whales operating at one time. A lot of times they operate together. Let me mute them. A lot of times they operate together, but just like anybody else, they're trying to make a living, so they will definitely step in front of each other if they have the opportunity. So if we get up there into this area and we find that there are sellers, what happens? It's Price's job to reconnect price action to the prior action. How do we do that? We come back and we orderly fill this area. It's like pasting this chart back together. So those are our thought exercises. Let me look at it again. If the sellers are not there, we'll likely come back, find support, and take off. If the sellers are there, we'll likely push up into this area, eat up some space or time, find that they're there, and if we're patient, find an opportunity. Just as I said, we would find an opportunity to get long down here. If the sellers are not there, if the sellers are there, we'll probably get an opportunity over in this area after time has eaten up some time or space and shown us that the sellers are there. Let's go back to the market. What did the market do? Price gaps higher. The market trades up and tests the gap once. Trades lower. You can take a look. We've got 4 or 5 nice bars lower. They're not wide. They're just normal volatility to sell off. And this might have you on the edge of the seat. Oh my God, it's in the gap zone. I have to sell quick before. But where are you going to put your stop? That's your first question. Second question is, one more time, where are the significant buyers and sellers? Well, the sellers are all the way up here. Yeah, I know someone's going to tell me that they could put it over the poke. Here's my answer. You can put it over the poke, but that's a poor man's stop. This is not a swing high yet. And the sellers that are here are not going to move down to this level yet. They have no interest. They're not going to chase price. They want to see just exactly what's out there. This is way too early for them to lower their price. There's 2 things that can get you in a lot of trouble if you're an active trader. 1, using cheap stops like this. 2, getting into the market too early. What will happen is, in both cases, you'll get stopped out of the market. You may end up being right about the direction. You get stopped out, then the market will take off. And you'll have no emotional or focus ability to take the trade that you should have taken because you just got stopped out, either at break even or a loss. You'll be paralyzed. So we sold off. Is this market heading lower now? We don't know. We don't have enough information yet. We have to buy a few bars and see what happens with time or space. I don't think, I normally would say this is not a mature formation. At the moment, this market is still digesting this huge gap. It's also out of energy. So when you get this huge gap, you can expect that price is actually going to trade a bit like this to restore the energy that it spent. It's like a car. It drove all the way. If you're living in Chicago, I'm living in Arizona, but if you're living in Chicago and you drive to Lake Geneva, you're probably out of gas. You have to stop and fill up. Same thing here. We probably need to eat some time and space and then see what price does. So let's see what we get. Sure enough, price makes one wave lower. Now it's doing a pretty good job coming back. In fact, it even took out the spike high. If you were short and used that spike high as a stop, you're probably stopped out. Sorry. Of double tops, people get all excited about double tops or double bottoms. Oh my God, that means the market's definitely topped out, or the et cetera, et cetera. You can find them all over the place. One of my close friends been at the CME as long as I have. Richard Dennis, very famous. Double tops, double bottoms made to be broken. Absolutely true. I don't know if these will get broken. It's not the point, but don't get so excited when you see these little small formations. Pay attention to them and know that there are going to be people that put orders here. But don't get all excited. Remember, where are the sellers? They're up here. Once again, people that were leaning on the double tops, they got popped. They're gone. Is there anything interesting enough to make me trade yet? All of you, take a look. Is there anything interesting enough to make you trade yet? On the upside, we're still making higher highs and higher lows. We also have a series of lows just below the gap zone. So we've got a multi-pivot line here as well, which at the moment is acting as support. Just like I mentioned the poke here, if you wanted to get long against this multi-pivot line, your stop is likely to get popped because there's no swings yet. We can maybe use this as a swing low. But there's no swings down here. There's nobody to lean on. And any minor break is going to bring out the retail, got to sell the new low. Or I got long up here when it took out the double tops. If it takes out these lows, I have to get out of my long. So, pardon my voice. Is there anything interesting enough to make me trade? No, not yet. But we are doing one thing that's extremely important. We're eating up time and space, time and or space, which means price is moving to the right. And that's important because we went vertical. Price has to restore its energy. Dr. Andrews was a thermodynamics professor, and he taught and thought in terms of energy. And having the physics degree that I have, I approach the market in the same fashion. I find it easier to think about it that way. Think about when the market runs out of energy, where it's likely to run out of energy, what it needs to refill. Extremely important. Price needs to eat up space here. All right, let's see where we're going. Oh. Now do you see something interesting? Somebody got it. Somebody's interested. Somebody went after these stops. Remember, the whales, the big boys, they have a fairly good idea what the market position is. They have a fairly good idea of how to wash and rinse you out of the market. And to be honest, if they're making a trade, they really don't want you along for the ride. They'd like to wash you out first. And I'm not saying that anybody's going long here, but they try and make it as painful as possible for everybody else that's trying to play along. But if you learn to read what they're doing, it doesn't have to be that painful. You can actually trade along with them. So this lower gap makes me sit up and take notice. Can anybody guess why? The market's long. Yeah, and sellers are taking advantage of that. They're testing the market. Let me push these sell orders and just see what I get out of it, so I can find out whether people are long or short. Well, much to their surprise, they get a heck of a reaction. Look, price climbs higher, but cannot test the gap high. It's a sign of weakness. And you got 3, 4, 5 whales with pretty large positions. They might have been taking profits down here. Maybe they want to reestablish their positions, but they're not getting their trades off at what I would call wholesale. They just tested the market and found everybody is long. Guppy food. You don't want to be a guppy. Now that price has my attention, let me see if I can find the probable path of price by drawing a median line. And again, median lines, let's take a look. Always need alternating pivots. I'm going to use the major high here, which is at the gap zone. I'm going to use the lowest low, which is pivot B. And then we come up and make this high, this regional high, slightly below the A pivot and gap lower. When we gap lower, I'm going to draw a median line, because if price begins a new downtrend, the median line has a mathematical probability with alternating pivots, high, low, high. It will give me the probable path of price, and it'll also tell me where price is likely to run out of energy on both the upside and the downside. It's something I can use. Now, why would I want to draw a median line? If this made me sit up and pay attention, let me read what I wrote. This fresh round of selling that gapped price was lower should be a signal that there are significant sell orders above this market. Price should not make a new high now, period. If price makes a new high now, I have no clue about this market. I now think it's likely that there are significant sellers. And so I want to project the next pullback in this market, because that's where I want to get short. I don't want to get short down here. I don't want to get short down here. I want to be as close to the bone as possible, because I'm cheap. I want my stops to be as small as possible. I want to up my risk reward, and I want to risk as little of my portfolio as possible, yet still be in the trade. So can I project the next pullback high? That's what median lines are for. So using A, B, C, a major high, major low, major high, nothing special about, no magic in how I pick these. If I want to, I can go ahead and take a look. Kind of grabs the sell-off here. I like it how it grabs the congestion here. Not much else to go on. The BC line does a good job here. But the key for me if I'm right, is I want to sell as close to possible above this pivot A, because that's where the sellers are anywhere down in here. I know everybody wants a black and white rule, but they're down in here, and some of them are going to front run each other. I want to sell as close as possible. Median lines give me the probable path of price. I don't want to sell down here. The stop's too big. The real stop, and I'm not going to be cheap on stops, is all the way up here. It's not here. This is not a swing yet. I wouldn't even consider this a swing unless we took out this low. And even then, it's so-so. The buyers may be in this area. The sellers, though, are sitting up in this area. And this is what's important. Identify the buyers. Identify the sellers. And look, I'm patient. We talked about it before. The market gaps lower. The specialists, the whales, the large traders, if you want to trade on the first couple bars, they're going to make you pay what seems like an exorbitant price when you look back at it later. Again, if you have a stop, accept being stopped out gracefully. That's what stops are for. But in terms of entering on a short on this first bar, look at gap lower, let me just jump on board. It's a loser. If you go back and do the statistics, these breakout trades are terrible trades because your stop has to be all the way up here. Price diddles around for about an hour, hour and a half, then spikes higher. This is the first test of this upper parallel. And we're going to do what I call a test retest setup now. This is my favorite trade. I probably 85% of my trades are tests and retests. And the reason why is on this first test, if price runs through, if I just have a resting order to sell at this upper parallel, the price runs through, it's accelerated, which Andrews, remember what he said, price can stop and reverse, price can accelerate. If it zooms, it can crawl along the upper parallel in this case. I don't want to sell something that's zooming. So I want price to come, test this median line, and not head higher. Here's my idea. I want to sell a retest of this upper parallel at 130.73. And all I did was I projected the next bar. I ran it down. And I said, okay, if I do that, where's my profit target? Well, median line theory says that price will make it from the upper parallel to the lower parallel. If we head lower, if we start to take out these lows, 80% of the time. Statistics have been done over and over. At least 3 doctoral dissertations done on this. Prices will come down to the median line. If it breaks to the median line, it'll go to the lower parallel 80% of the time. If it doesn't make it, it turns around, it'll make the upper parallel 80% of the time. The statistics are rock solid. So it only makes logical sense that if we head lower and take out the lows, price will make the median line 80% of the time. Now me, I've got a couple things I'm looking at. Bottom of the gap, and where to put my profit target. I could put it at the median line, but I want to make sure I'm filled. So I'm going to actually put it 5 ticks above the median line to make sure I lock in profits. I find sometimes, if you take a look here, here's a quick little tip for you that I wasn't going to throw in, but I will. Take a look here, and you can look at the slop, how far we went past the upper parallel. Just happens to be 5 ticks. That gives me a good feel for how much slop is in this median line if it's going to work. So I'm going to put my stop 5 pips above here. And so often you'll see that this overshoot will lead to an undershoot that's an equal amount. So I'm going to put my profit target at 129.33. So I'm going to sell a retest at 130.73. My initial stop loss is above the A pivot. I'm not going to go cheap. I'm not going to put it above the C pivot. I'm going to put it above the A pivot because I think the whales are going to be sitting right here all the way to the C pivot, right in that zone. And I want to make sure that I'm able to lean on them. My initial stop is going to be 30 ticks. That's about as wide as I get on a 20-minute chart. Let's take a look. Does this trade make sense? Prices in the pullback or sell zone, right up in here. We call this a pendulum pullback. What about the risk-reward ratio? And again, this comes from Amos. I'm risking 30 ticks to make 140 ticks, which is a risk-reward ratio of 4.67. Price will need to break below the bottom of the gap here at 129.98, but if price approaches that area, I'll already have a potential 70 to 75 ticks of profit in the trade, and I'll be more than willing to try and collapse my risk. Now, the initial stop loss is 30 ticks, which is about as much as I'm willing to risk in this time frame. But this is one of my favorite setups, the test and retest. So entering on a retest, I had a pullback where price should run out of energy. That's one of my bread and butter trades. The word got cut off here, but the risk-reward ratio is very good, 4.67. I don't take anything less than 3. When I portfolio trade, which trades go weeks and weeks and weeks, I look for 5, 6, 7, 8, 9, 10 or to 1. I'm not looking for 3 to 1. But when I trade on 20-minute or 240 minutes, I'm looking for 3 to 1 or better. 4.67 is a very nice risk-reward number. What do we get? First, let me get a drink of tea. Price comes up, we get filled on the next bar. So I'm short at a retest of the upper parallel at 130.73. I always work my stop loss. At the same time, I'm working my limit sell. If I'm a buyer, I work my stop loss. At the same time, I'm working my limit buy. That way, I'm protected. If news comes out and you don't have your stop in, but you've got your limit sell order in, and it's big news, and you're trying to punch it in, you're trying to mouse out, you're trying to do whatever the heck you can, good luck with that. Put your orders in at the same time. You can type them and park them and make them non-active, and then click them both and make them active. But don't leave home without them. Don't ever trade without a stop, and don't ever move your stop worse. You must trade with stops. You must honor your stops. You get stopped out, that's what stops are for. That's what keeps your balance, the account balance, alive. Because even good traders have losers. We just want to limit them. So we come up and we get filled. I'm eyeing the bottom of the gap because that's going to be my first area, the first problem. I might find potential buyers here. Again, my profit target is 5 ticks above the downsloping median line at 129.33. Got a high risk-reward ratio. Okay. If I hadn't had my order in, good luck with that. I'd be gone. I should say the market would be gone, and I wouldn't have got a fill. I wouldn't have a chance for a second bar. Price comes lower. There's an alternate entry here at the bottom of the gap, but the stop's not very pretty. It's not as pretty. At that point, you'd have to be using the C pivot, I guess, to be able to afford the trade, and hope that this poke and the C pivot have persuaded the major players to move down to this area. But it's much nicer if you can get in close to the bone here. But this is selling the bottom of the gap. That's an alternate entry, certainly possible. And then you can see price left a ledge here, similar bottoms. Came up to test the bottom of the gap one more time, and then sold off hard. On this wide range bar that closes near its lows, I'm not doing the happy dance. Okay, I've got like 70 pips in this trade. I'm not walking around going, yeah, I got my 70 pips, I got my 70 pips. No, the trade's not over. What I want to know is, are they going to find buyers at the bottom of the gap? And is this all I'm going to get? So, the very first thing I have to do is collapse my risk. I'm down in an area where we could have problems if we're short. I don't have any structure that I'm willing to lean on up here. So I'm just going to go from having my stop loss up here above the A pivot. I'm just going to go to break even. I've got 70 pips in this, which is a nice chunk of change very quickly. If it backs up on me, at the moment it's a lotto ticket. I'm playing with the market's money. If I get a chance to move based on market structure, I will. But at the moment, I don't see any structure that I'm willing to trust. And any structure I have is so close to going to break even, there's no point. One other thing to point out. When you're trading on down-sloping lines and you're short, as I am, this is the median line, and I'm basing my profits off the median line. My prior profit target was 129.33. But because this is a down-sloping line, and price has moved to the right, so that's time or space, when I run my cursor straight down, I find that it intersects at 129.20, and I'm going to be 5 ticks above it. So now I'm at 129.25 is my profit target. So my risk reward is going up if we're able to break through the bottom of the gap. You need to pay attention to these types of details because this is extra money. It's laying on the table. Pick it up and take it. Okay. There were no buyers here. Take a look. Wide range bar lower. Wide range bar lower. Wide range bar lower. Price leaves a wide range bar lower and then a spike low. It pulls back and makes another new low. Everybody see that? Does this make it sit up? Now, if you weren't able to get in, at this point, price has left the station. We'll focus on some alternate entries next month. But if you're in close to the bone, don't do the happy dance. Instead, do the how do I manage this trade dance? Let's take a look. Price leaves a wide range bar, a spike low, then pulls back, then makes another new low. Wide range bar, look, it's closing in its lower third. Now, at this point, I don't know, my eyes aren't that good, 120 pips, 120 ticks, maybe a touch more into this trade. I can't let this trade turn into a loser, first of all. And I have to actually, yes, this is still the euro. We're still in the same chart. I have to actually take some money out of this market. There is a point A where you have to collapse your risk, and there is a point B where you have to get paid no matter what happens. And if you started out with a 30-tick stop loss, and now you have 120 ticks in the bank, you have to make sure that this doesn't back all the way back up on you. So, I take a look, I call this a little do-si-do. You can see price came down with a wide range bar, consolidated a little bit, got some of its energy back, left a little high. This is not a swing high, folks. It's not a swing high. This is all one movement. This is all one bar. Think of it that way. If we just connected the highs and lows. This is all one cascade lower. So I can't call this a swing high, but I guarantee you there are people that are caught long and they love to get out in this area. I'm going to work a stop profit order to protect my profits at 130.08, which is 5 ticks above this high. If price turns higher from here, I will have locked in 65 ticks of profit in the euro futures, euro currency futures. It's important to pay attention to these possibilities. Price will sometimes turn on you. So if you have the opportunity to hide your price above what looks like a potential area where there would be people that are caught long, there would be sellers, go ahead and do it. It'd be better if this was a swing high. This is the best I have at the moment. But I've got so much in this trade, I have to keep locking in trade, locking in money. I'm just going to keep locking it in and boxing it in and boxing it in until we get down here. One more time. Price comes down. There's our friend, double bottoms. Everybody's all excited about the double bottoms. We get a pullback on the double bottoms. And we make a new low. So good luck with that. What's the context of the market? At this point, the context is lower. Forget about the double bottoms. They're meaningless. The context says, remember Newtonian physics. Things in motion tend to stay in motion. Things in a downtrend stay in a downtrend until it's not a downtrend anymore. Double bottoms or no double bottoms. So you get a knee-jerk reaction and then quickly make a new low. Now I am working a stop profit order at 130.08, but look where we are. We're 129.30. I'm leaving a lot of money on the table. I'm leaving 70, 80 ticks sitting on the table if I leave my stop there. My risk reward, we call this dynamic risk reward. My risk reward is turned on its head now because look at how close I am to the prior swing low and the median line. I don't know, 20, 30 ticks away, but I'm willing to risk 80 to make those 20 or 30. No, that's backwards. That's wrong. So what can I do about that? Well, double bottoms, double tops, I'm going with the flow. I'll bet there's some people that are caught long that are willing to sell if it gets anywhere near this congestion area up here, just as they did up in here. So I'm now working a stop profit at 129.76. You can see I drew in the line for the next part, what if. I also have my eye on this prior swing low. If price turns higher from here, I've protected 97 ticks of profit. 97 ticks would be a good day. For a lot of you, and I don't mean it in a bad way, I mean it literally, 97 ticks is a good week. 97 ticks in the euro currency, that's a nice week. You don't have to be a pig. If you can make 97 ticks every week, that's a living. So I've moved my profit order now for the third time. Now my profit order is right at the median line now, 129.06. Why? I'm a little nervous about this prior swing low. I think we'll probably get some more action. I call it action Jackson. Some more push out of this. I think some more people tried to buy it. They're trying to pick lows. You can see them. They tried it here. They tried it here. They tried it on the double bottoms. I think we'll get one more cascade lower. We might get a lot more, but I think we'll get one more cascade lower. And we're so close to the median line, I think we're likely to hit it somewhere in here. So surgically, just like I was looking for this pullback here, I'm looking for price surgically to come right to the median line. And then I have the same possibilities. When it gets to the median line, it can stop and reverse. It can accelerate through. But what I care about is, at that point, I'm going to have a lot of money. Give me the money. I know with 80% certainty that it's going to make the median line. That's Andrews 101. Why not take the money off the table? I can always find another way to get short. I can always find another trade. Logical places to put orders are more difficult to find. What do we get? Next bar. You get a drink here. And I mean tea. Price comes down, comes right to the median line, goes through it by a couple ticks. I get filled at 129.06. First thing I do, and I recommend this to all of you, if you don't know how to do it, Cynthia and other people from her group will be more than glad to show you. Check your audit trail. Did you get filled at one? Just because the price printed, did you get filled? Second of all, does the exchange say you're filled? And most important, take a look at the P&L, see if it makes sense. Take a look at your net buys and net sells. At this point, you should have zero position on. And last, there's that little button that says pull my orders or pull all my orders, cancel all orders. Hit that button about 3 times. Drives Cynthia crazy. Because the last thing you want to have happen is to have this stop profit order sitting there and forget to pull it if you got filled on the profit order. And then when it gets up here, oops, you get filled. And I don't know about you. Anytime I get filled on one of these orders by mistakes, and it happens to everybody, to me, they've always been losers. I had a partner in a prop trading room, and he always seemed his were always winners. So I know where they go. There are people that get them, but it's never seemed to be me. You can use, or once somebody said one cancel orders, the other. You can, but you still want to check your audit trail and make sure, just so you know, don't rely on the machine. Okay, it's money. That's why we're here. We're here to make money. Check your audit trail and make sure that the machine canceled it. What if the one order was not transmitted? That happens. So double check. Take the time. It's too hard to make money. You don't want to give it away on a mistake. Okay. So while price is down here, check the audit trail. Make sure that you have no position. Make sure all your orders are canceled. Then the next thing I do is I actually do the math and go, okay, if I short here and I'm out here, and take a little bit for brokerage. Okay, that's about right. All good. Let's see what the market did. Well, not so bad. Gave you one more chance to get long, or get out of your shorts if you wanted to. If you wanted to get long, I don't see a reason to get long. I still see a downtrend, but it did rally nicely. And the nice thing about being out here at the median line is I didn't have to sit through this rally at all. We rallied about 60 ticks, from where I took my profit, and I didn't have to sit through that. And then if I was still short, I didn't get dragged by the bus here while price restores energy. So I'm out. I can plan my next move. My head can be clear. I can go take a walk. I can go to lunch with my wife. Do whatever I want. But the important thing is, I got short here. I'm out. It's clean. I'm done. Now I can focus on another market. I can focus on this market. I can be done for the day. I can be done for the week. I'm out. I got my money. This doesn't bother me at all because I'm out. Now, lastly, once again, a new gap. Here's a gap. Here's another gap. So once again, it starts all over again. There's always another trade. One edge, let me mention this, and then we'll go to questions. One edge you have, the single biggest edge that you have, an edge that you have over whale traders, hedge fund guys, money managers, people that work for prop rooms. You can trade when you want to trade and be out of the market when you want to be out of the market. If you don't like the way a market looks, don't trade. You can take your profit and stand by the side. People at a prop room are paid to trade all the time. Period. Hedge fund guys, you go 2 days without a trade, the phone lights up like this, like the world's ended. Well, why don't you have any positions on? They have pressure not only to perform. You'd think it's just, why aren't you performing better? One year I was up 56% in June, and I had 3 days without any trades, and I couldn't stop the phone calls. And I was so mad, actually, I canceled all my retail accounts. That was the end. I still have the same 4 sovereign wealth funds. I kept them. I got rid of all the retail accounts because people were like, why don't we have a position? Isn't there anything going on? What are you doing? We're up 56%, folks. Relax. But for a lot of people, it's the action. It's like gambling. It's not just profits. They need to see action. And traders are that way as well. And if you're like that, you need to beat that out of yourself, okay? Trade when you want to trade. When we were up in here, trading too early is a sin. It'll cost you everything. Don't trade till you're ready to trade. Trading too early generally will mean, look, if you tried to get short here, tried to get short here, it was too early. Price needed to eat up space. Even this, although it was a better price, was probably too early. This was the key to the trade. And you still, believe me, down here, everybody said, oh my God, I'll never get a chance to sell it back up in the gap zone. But 80% of the time it comes back up here. And you do get a chance. Just be patient. Wait for the trade you're looking for, then execute it. If you miss it, you miss it. A missed opportunity never cost you anything. Trading too early, you could have got stopped out of this one. You could have got short here, you would have got stopped out. This one, maybe you wouldn't have got stopped out, but it wasn't that pleasant of a ride, especially after seeing this gap and then watching it come back up. You probably would have collapsed your risk and gotten shaken out. Then the market actually got to the correct sell area, and you were able to harvest the whole thing. But if you got shook out early, you probably didn't have the fortitude, the focus, the ability to jump back in on the short side. Most traders do not. So we took out, we risked 30 ticks, took out 167 ticks. My actual risk reward on the trade originally was 4.67, and then ended up being 5.5. And as a trader at the end of the month, you want to take a look. What did I think my risk reward was going to be, my potential risk reward, and what was my actual risk reward average? And they should be relatively similar. If they're not, you need to go back and review your trades and see, because you're mismanaging stops, profit stops, profit targets. All right. I know we're a little long, but that's normal for me. I'll be glad to take some questions. I want to mention 2 things though beforehand. One second. Here's one of my buddies from Coral Gables Group. Execute the trade, not yourself. Absolutely. Good to see you, by the way. Please do me a favor, and Cynthia will show you how to do this. We want to go to on the IB webpage. We want to go to the marketplace, the IB marketplace. We want to go to the educators tab. If you like this presentation, there's the IBs. I like that.
Hey, Tim, I'm sitting listening to you in the background, and I thought I would, while you're describing it, I did want to tell everyone where it is that you're looking here. And it's on our education menu. Notice here there's an IB Marketplace. Now, for those IB clients, we do have, notice here, when you go to the Marketplace, first of all, there is an educator's link. And Tim has just been approved as an educator here. But we would like to ask for your ratings here. Any comments or information like that you can vote on. Now, you do need to be an IB trader and create a voting ID in account management. It's under the user management section at the very bottom of your page. But as soon as you do, if you come in and give a vote, we'll actually move Tim up in our settings here, move him closer to the top. So I did want to mention that. Your vote really does count, so thanks.
Only vote for me if you like, if you didn't like the presentation, I get it, that's fine. If you do like the presentation, please do me a favor. It helps to be listed higher on the educator page. It helps Cynthia, when Cynthia goes to management and says, hey, we're doing these on a monthly basis, and we don't do that for anybody else, and they go, well, why not? Well, because look at the results. I mean, lots of people come to see Tim. So, if you liked it, it's all good, and, you'll be doing your rating.
Well, Tim, while you mention that, I'm going to take just half a minute here and open up the poll, because this is something that our management team looks at on a weekly basis. So I do ask your help in actually participating.
Can I mention something?
Oh, go right ahead.
Don't forget, somewhere in here, you got to mention webinars. Please. Why? Because that helps Cynthia's educational group.
Super. Thank you so much, Tim. Now, also, the poll has just ended, and I realize that happened very quickly. But if you've got comments or questions, you can always send them to me at webinars@Interactive Brokers. Again, that's another tool that management uses to monitor these events. So comments, questions, or suggestions are always welcome. Thanks, everyone. I'm actually going to move this back. I'm going to close out of that polling panel right now, and let's move back over into Tim's window where you can all view the information or enter any of your questions right now. Well, let me actually close that polling panel down, and you can close it as well simply using the minimize button on the right-hand side of that title bar. By the way, everyone, if your chat panel has collapsed, you'll find it at the very bottom of that right-hand side. Simply double-click that title bar, and you can expand the chat panel and send any of your questions or comments. So back to you now, Tim, for those questions.
All right, I'm trying to get rid of the poll. Hang on a second. There we go. I got it. Let's see. Would I take half my profits now? I'm not, you know what, I generally don't split profits. I'm a keep it simple guy, KISS. I generally I'm in at this price and I'm out at this price. Now, if I have a very large position, sometimes I have to, work the market over, so to speak, to get a complete fill. But I don't take partial profits. I also don't scale in. I'm in, I'm out. That's it. Keith says, you mentioned in any one time zone, there's always 4 to 5 whales. Who are these? Individual traders trading billions of dollars. Yes, that's correct. I can name a handful of those people. Or hedge funds, institutional traders. Well, hedge funds, yes. It used to be bank market makers were a big part of that market, but of course, there's been recent changes. It's called the Volcker Act, and they're basically out of that business. So there's more of the volatility and or volume in the market will now be hedge funds and large traders like me that are trading, carrying positions. Small positions are $2 to $3 billion. Big positions are 20, 30, 40 billion dollars in the euro, for example. Are these people using median lines as I do? I know a number. In fact, I mentored a number of hedge fund managers that trade billions of dollars early in the 2000s, in 2003 through 2005 through a group that the CME group sponsored. And there are people out there that use median lines that manage a lot of money. But the good news is, relative to the rest of techniques being used, median lines are a drop in the bucket. And I don't mind. I don't want everybody to know about it, but I'll be more than glad. I want to keep Dr. Andrews' methods alive as well as Amos's methods alive. So I'm not particularly worried about it. How did I decide to use that point C? There's a chart. It's the highest high. Thank you. It's the highest high after the A pivot. We make a pullback, then price makes a leg up. When I see the gap, in my mind, I'm playing what if. What if this is now a downtrend? To me, this has the earmarks of a downtrend. Well, where's my likely pivot? My likely pivot is the highest high. So I'm just doing nothing special. This high, the major low, the next high, right before the gap. Nothing magic about that. You didn't get a chance to vote. That's okay. Just send a nice email to Cynthia, and it'll help. Again, it'll help her education department. What I really love about Cynthia's education department is they're not. Look, I like interactive brokers. That's not the point. They're not here to push interactive brokers. They're here to educate people. You didn't hear anybody trying to sell anything, whether it's me or IB. We're just here trying to help traders get better. That's it. The longer you're in the market, the better off it'll be for everybody. We'd love you to be in the trading community for the rest of your life and become better and better. And Cynthia is one of the few people in this business, along with Dave Schultz from the CME and Barbara Schmidt-Bailey from the CME, that's their interest, period. It's the FX market. What is 24 hours, but your chart is not 24 hours. No, actually, my chart is 24 hours. The CME is closed for 1 hour. It's just they do maintenance and a couple other things. So this is a 24-hour chart. One of them is a weekend gap, and another one is a gap while they were down. That's all. Katie would like me to make a seminar on how to read different bars. Yes, absolutely. I appreciate the ideas. We're going to be here every month. That's coming up. You missed some of the presentation. Everybody will get a link shortly after we close the chat windows here that allow you to come and watch the recording. You'll also get the slides. As soon as you close it, you get the slides, and you can follow on the slides. Alex says, shouldn't we have had the median line construction from point B after the major drop that we had earlier? I don't know if you meant an upsloping one. The problem is I don't see any change. I don't see an event that makes me think that we're in an uptrend. I see this as a pullback. You can certainly put in an upsloper. Let me ask you a question. You can have a minor one here, and I talked about that. You could go low, high, low, but it's very skinny, and you're going to trade out of it very fast. Those are not high probability median lines unless you're trading very small time frames. Why did I use the high of 1222 here instead of the slightly higher high here on 1221? I think I have that right. I have the days wrong, but we both have the days wrong, but I get the idea. This is the point of ignition. This is the gap. This is just, it wouldn't make much difference other than space has gone on, but price has gap. This is it. That's simply it. If I missed your question, just go ahead and pop it back in there, by the way. Are there a lot of whales trading CME futures opposed to Forex? Michael, I like to trade CME futures. There are times, I'll be honest with you, there are times when my positions are too big for some markets. Although, I particularly like the Aussie market, and there was a point in time 2 years ago where the Aussie market wasn't large enough for me to do too much. I could do several billion, but now it's getting to the point where you can actually do a fair amount. So I like it because it's transparent. You know exactly where price is. I'm a little unusual because of the funds that I trade. I'm actually generally able to get a price on my whole gagging amount, usually. And if that's the case, there's no slippage. So sometimes I'll resort to that. But, I love trading the CME futures. If I am day trading and putting around, this is definitely where I'm trading. And it's not just currency futures. Gold futures, oil futures, a lot of things that this is where I put bonds. There's no better place to trade bonds and even the S&Ps. What or do you recommend to focus on one currency pair? Well, I would say this, Juan. You're better off understanding one pair and being intimate with that and getting to learn its nuances and how it trades and what an interesting bar or gap looks like in that one pair. Then you are, when we do private mentoring, one-on-one mentoring, the first thing we see from almost every student, they come in and they're looking at 20 pairs. And I have to tell you, looking at 20 pairs, if you're intraday trading, you are lost. So that's a good observation. I would much rather see somebody start out with one pair. If you do find there, first of all, if you do find there, you don't have to do anything. You can just keep doing it. But then you can move on to another pair if you want and add 2 or 3. I like to tell people in mentoring 3 to 5 currencies is more than enough. And, make them non-correlated. So don't do 3 yen pairs against other things, but make them relatively non-correlated. I really think you're well served. Dave mentioned this earlier. Currencies that have actual flows, commodity flows, Aussie and the Canadian dollar both. I love having them in my portfolio because people have to trade because they're paying for those flows. They're buying oil or they're buying metals. They're selling oil. They're selling metals. That has to go into the market. So that's a natural flow. The euro, it's more a financial flow. The yen, it's more a financial flow. The dollar at the moment is still the currency of choice, so that's a financial flow. But I like having those commodity currencies in my portfolio, and I'd recommend if you're doing 4 or 5, that's a great way. Am I drawing my median lines in the 24-hour market? Yes, I am. You're confused on how the median lines are drawn. Okay, well, your charting package will have it. All I'm doing is I'm grabbing alternating pivots. They always have to be alternating. So high, low, high, or a low, high, if it's upsloping, low, high, low. Then, if you were drawing them by hand, you would connect the B pivot and the C pivot and just draw a simple line. And I still hand chart, so I still draw by hand. Then you find the center. You bisect that line. You take that center, you project it backward to the A pivot. That gives you the slope. Now you can project that line all the way out. Then you copy the slope, roll it on up to the C. That gives you the slope of the upper parallel. Roll it on down to the B. That gives you the lower parallel. The good news is, when I started this campaign in 1995, Dr. Andrews died in 1987. Charting packages didn't offer median lines. And I was on the CompuServe forum. This was before web pages. It was before blogs and all that other stuff. But we had CompuServe and all these other places where people would gather to just share ideas. And I would post charts of median lines, 30, 40, 50 a day. And I still have people at Market Geometry and some of the Coral Gables group that follow my posts. And slowly and surely, median lines have found their way to every charting package possible. And then all you have to do is just grab the high, grab the low, grab the high, click it, and it'll throw the median line in for you, as well as some variations, modified shift median lines, et cetera, et cetera. Let's see. When you use the term buyers, sellers, do you mean an initiative buyers or sellers taking new positions or exiting positions they hold? Well, buyers or sellers, it doesn't matter to me, Bob. Excuse me. There are times where the market, where even the whales get caught. And then you'll see price will come down, let's say, at this point, when they realize that they're not going to get the price they want and price gaps lower, they're going to take anything in this gap zone. They're willing to sell anything here. So in that sense, they're caught. Are they initiating positions? They might be. They probably are. What would be a non-initiating position? Well, General Motors, for example, might leave an order with somebody and say, look, I have to hedge $30 billion that's coming out of Europe for my car sales. Now, he's not initiating a position, he's hedging. But it'll still act the same way. And where will it cluster? In general, it'll cluster in the same area. He's probably getting good advice from somebody. Andrew's pitchfork is what, I'm not going to name, but I know who you mean. Software has. Is that exactly the same as median lines? Yes, it is. Do I watch the 25% median lines and 75%? Don't waste your time, please, Siri. It's a waste of your time. Think you're swimming, who you're talking about. Tom Susness' company, who's got bought out. But yeah, no, just take them off your chart. Watch the median line, watch the upper parallel, watch the lower parallel. If you want to watch extra lines, put the warning lines out here, which are the same width from the median line to the upper parallel. Put it out here and put it down below. A lot of times when price busts through, that'll be a great area to pay attention to. Do we have to draw the lines manually, or is there a way to do it on our charts for us? Cynthia, I'm going to defer to Cynthia, and you might have to email her whether IB has it on their platform. It may depend on which platform you're on as well. If not, I'd be glad to help the tech people there do it. It's very simple. But you know what? It's very simple to draw them by hand on the chart.
Tim, if I can break in right here. Now, using the APIs, if you do have access to other software that will create the pitchforks, you can actually link your account. But directly in IB's charts, if you draw a trend line, you can, or draw that trend line for your median line, but also be aware that in the global config screen, you can actually auto-complete the trend line so that as the chart continues to grow, that trend line will still remain on the chart. But then also to draw those pitchforks, simply right-click on that median line, choose Create Parallel Line, and then you can place it as well inside. So a couple of extra steps, but definitely you can, utilizing our trend lines, you can create these charts as well.
There you go. I like it. And it's also, it's in the chat as well.
And I just put it in there. But also, Alan and anyone else, if you do want to send me an email directly, you can always write to webinars@interactivebrokers.com. But as we leave today's event, I'll also have it up on the screen. So thank you.
All right, so let's see. So there are third-party APIs that you can add. But it's not that hard to draw, especially because they automatically give you the parallels. But all you have to do is find the BC line. That'll give you the slope. Then, as she explained, click, grab the slope, and you can put it on both sides. You're home free. Cynthia's contact will be at the end. Can you use range bars? Absolutely. You can use range bars, tick bars. For example, when I trade bonds, my favorite is 1,444 ticks. It changes based on how volatile the bars are. At one point it was 352 ticks, but range bars in the currencies, one of my prop buddies uses 8-tick range bars. That's just bread and butter. I like tick bars better, but I'm not above using range bars. I think it hides a little bit of the market structure, but if they work for you, and my partner, he was my partner in my prop room, makes lots of money trading range bars in the currencies. By all means, go ahead. Do you trade other people's money? Manage futures? No, Dory, I no longer manage public money. I only manage money for four countries. sovereign wealth funds. So I used to manage retail money, and to be honest, I just don't. It's you'd have to have several $1 billion to even get a return. These are people that have actually been my customers since 1985. So we know each other intimately, and they don't worry about me at night when they sleep, and I don't worry about them calling and complaining, and makes my life easier. It also allows me to do things like this. So I don't manage monies publicly. There are people out there that do. There's nobody I can recommend to you. I don't know if I don't follow that. I don't know if IB does or does not. Webinars at interactivebrokers.com is a great place to email. Absolutely. What else do we get? Did I miss anything else? If I missed anything else.
Well, what I'm going to do here, because we've gone very long, and I really want to thank Tim Moore for today's event. I'll let you come back in and add a couple of more comments, but I do want to remind you that we have a monthly date with Tim. It's every Thursday, 12 o'clock Eastern Standard Time, or I'm sorry, not every Thursday, every second Thursday of the month. Now, you can sign up at any time. We'll be having next month's event. We'll be listing within the next week or so, and you can always pre-register at webinars, underneath our education menu, there's a webinars link where we'll have access to upcoming events. So please do check there, but also notice that on our education page, even if you just put a date in your calendar on the second Thursday of the month, you can always register, sign up, and join all at once by simply accessing that education menu. So thanks to everyone here today. Any more questions for Tim right now? Or that you're seeing, Tim? Also, be aware that as you leave today's event, you'll actually get a PDF copy of the slides available for download or printing directly from there. So if you do want to come back and revisit those concepts that Tim was talking about, simply print those copies as it comes up today.
I got two, and then I'll let you go, Cynthia. I know it's a long day for you. First of all, before I forget, there's a reason why I'm willing to do this every month with Cynthia. Barbara Schmidt, I'll get this out. Barbara Schmidt-Bailey from the CME group introduced me to Cynthia. It's been a long, Cynthia, I'm not going to rat you out. It's been a while. But the three of us have done a ton of work together. And the reason why is because, as I said, Cynthia is interested in educating people. She's not interested in selling anything. I mean, she'd love to have you open an account with IB, but that's not why she's here. She's here so that when you walk away, you feel like you learned something. And I hope that's how you're going to walk away today. I hope you don't I mean, we're not talking about books or anything else. We're talking about the market, how to read the market. Now, maybe this doesn't work for you. That's fine. That's okay. But hopefully, even if you don't like median lines, hopefully you picked up some tips about how to read the market, what gaps are, what wide range bars are. Maybe you get an insight into what it is that a large trader, somebody like me that's trying to sell $20 or $30 billion, where my orders might be. If you just walk away with that, a sense of how to read the market, you're going to be ahead of the game. So Cynthia is willing to do this on a regular basis. By letting me do this monthly, it makes it so much easier for us to plan because, I can say, okay, now what would I like to do for next month? And we've got a couple things up in the air. We've already had a couple quick questions asking what's the next presentation. One of them is we are actually going to continue this on because I had to break this up. There's a beautiful use of wide range bars on this same chart that comes right after this. You saw let me go to the end. I got to this point and then I went, if I go any farther, this is going to go 4 hours. After this gap, here's some homework. Take a look at this chart. These are 20-minute CME 24-hour charts. Take a look after this gap and see if you can find what happens to the wide range bars and how they trade very much like the gap trades. Okay? Go ahead and take a look. You'll get the presentation right when we close the window. Don't worry, Dory. Hey, Mark, how you doing? There's a couple of friends that haven't heard me talk for a while. Always nice to see people. All right, so one last really good question here. Oh, my God. Well, Ken, My fear, Cynthia, I know this is walking on thin ground, but let me answer this because I had another friend call me. My fear is what happened to MF Global. How can I open an account and know I will not lose my money like MF Global do to retail customers? Well, my first advice to you, and I have not talked to Cynthia about this. I'm treading on thin water here, but thin ice. Excuse me. The very first thing is you want to have a segregated account. And that means your money is protected. But second of all, if you're trading through the Chicago Mercantile Exchange, they are the largest exchange in the world, and they run and own the clearing corporation. They stand behind every trade. You're not going to lose your money, okay? IB is out front of the pack. I don't endorse anybody. Nobody pays me a dime. I do this because I like IB's educational group. That being said, I'll tell you what, I've seen several moves that the president of IB has made and scratched my head and said to my friends on the board of directors of the CME group, what the heck are they doing? And every time that happens, you know what? It turns out to be golden. So they're a very good group. They're head smart. They're ahead of the pack. If I had to choose a place to be safe, I think IB is the place. And this is, I'm not saying it because I have any link to IB. I'm just saying it because I know there are people out there scratching their head saying, MF Global, what am I supposed to do? Well, I'll tell you what, I've seen 100 MF Globals come and go, at least. And I've been on the end where you have to close out positions for clients and move them over. So, you know, I think IB is all good. That's just my opinion.
Well, thank you, Tim. But I'd also like to tell Ken he can read all about it himself. We actually do post that information on our website. If you simply go to the YIB menu, once logging into interactivebrokers.com, there's actually an individual account. Same information appears on our institutional portal. But since Ken was talking about individual traders, that's where you can locate all of this information. There's a YIB menu and a strength and security section there where you can learn all about our dedication to keeping your account safe and secure. So excellent question, Ken. Please access the website for additional information.
I think that's great. I think let's call it.
Okay. Well, that will end it today, but we're going to same time next month. Oh, okay.
Well, let me give you one more, and then we'll end it. What steps do you recommend for a new trader to get started with median lines? Rick, here's what I don't recommend. And I know this is, Cynthia, don't laugh. Do not go to my website and spend a lot of money. Don't go buy a bunch of DVDs and seminars, et cetera, et cetera. Don't, look, you need to find out whether or not this makes sense. How about this? Go to marketgeometry.com, and you can, here, we'll go to the next page. Go to marketgeometry.com or medianline.com and look for the free information area. And there are at least 100 free articles that will take you 3 or 4 months to read and digest. And they'll tell you, and they run from median lines to money management, as Amos taught me, to what to do so you don't end up being frozen as a trader, and what it's like to be frozen as a trader, because I've managed hundreds of traders at a time over the years, to anything you can think of. There's all kinds of articles there. It's all free. There's also all kinds of video clips. We have a YouTube channel. There's all kinds of free stuff. The first thing I would do is go there and spend a whole lot of time looking at free material. There's nothing wrong with free, okay? Then, if you like it, you can jump in, okay? But don't go spend a lot of money.
Well, Tim, I'd also like to mention here as well is that for IB clients, we do provide a paper trading account, which uses real-time or live market data quotes in a simulated trading environment so that you can go in, you can practice, take a look at the trades that you see setting up, and follow those trades through as if you were trading live. But the only difference there is that your trades will never be presented for clearing so that you can try that out before you actually start risking your capital. Then when you become more comfortable, it actually makes the transition over into live trading relatively seamless. So I do want to make mention of that. Well, it looks like we have come to the end today. I think we could probably keep Tim busy all afternoon.
What do we got next month?
That's right. So same time next month, let's meet again right here with our webinar program. So thanks, everyone. Vernon is asking, do you need a funded account? And yes, you do. It is because of the way we charge for our market data subscriptions, you do need to have a funded account, but then once it's funded, you can open up a paper account at no additional charge. We actually mirror those same market data subscriptions. So you will need to have a funded account. You can also try this out on a demo application, but unfortunately that demo only includes a week's worth of data, and it is simulated data, not live, not real time, not even delayed. So do be aware of that. But with our paper account, you do get access to those real-time quotes and can see the market as it's progressing.
And
Taz,
you don't have to fund it with $1 trillion. You can start small and add some more.
and hopefully do well enough to add quite a bit more. Taz has an excellent question to end today's event. And yes, we have been recording today's event. It normally takes me about an hour, sometimes a little bit longer, to compile and upload to our servers. But just as soon as it becomes available, you'll be getting a direct link in your email just by registering for today's event. So watch your email later on this afternoon, and you can come back and review this at any time that is convenient for you. By the way, it will also be posted tomorrow on IB's education page. You'll find a webinars link to our recorded sessions. Just make sure that you do check under the industry sponsored tab. And by the way, while I'm mentioning that page, you'll also be able to access there. We do have a filtering button or a filtering field at the top. So if you'd like to listen to other presentations that Tim has done, simply go underneath the speaker and you can filter that page and view all of Tim's previous presentations with us. So looks like this is going to end our event today. Tim, thank you so much. And I also want to thank the CME for making today's event possible. So have a great afternoon, everyone. You can exit using the X in the upper right-hand corner of the screen. So thanks all. Have that great afternoon, and do trade smart. We'll see you all next month. Thanks, everyone.
Thanks, Cynthia. You take care. I'll see you next month.
Thank you, Tim.
Bye-bye.